25 seconds away from the opening bow this morning. Good morning as we wrap up the trading week. 3-day winning streak on the S&P 500 after the close yesterday. That is the longest winning streak since November, believe it or not. That's how bad it's been. Equities right now down about 0.9%, looking to close out the week, maybe on a softer note on the Nasdaq, down by about 1%. There's your opening bow. Switch at the board and get to the bond market. Yield shaping up as follows. 10-year yield higher by a couple of basis points. 345.95 on a 10-year. In the FX market, the dollar trying to show some strength. Euro dollar 108.03. We're down about 0.5%. Crude approaching 80. $79 and about 10 cents, up 1% on the day. About 15 seconds into this, equities down by 0.8% on the S&P. On the Nasdaq, we're down about 0.8%. Also, one sector to watch at the open, the big banks. JP Morgan, Bank of America, Citi, Wells, kicking off earnings season. Abby has the price action. Hey, Abby.
Hey, John. Well, yeah, a bit of a disappointment here. We can see that all four of these big banks are trading to the downside on the unknown of the macro situation and what it could mean for revenue and profit going forward. Now, relative to JP Morgan, that stock is down about 3%. They had a disappointing net interest income guide of 73 billion versus 74.4 billion. That was the estimate. Citigroup, interestingly, the stock had been almost higher earlier, right now down about 1%. Their FIC trading, they actually smashed that number. The iBanking and equities a little bit light, however. Bank of America, those shares are down 1.2%, relatively clean quarter, beats in net interest income. And then rounding it out, Wells Fargo doing the worst at this point, down 3.4%, surging expenses. They miss revenues slightly. They do expect the economy to worsen. Now, if we take a look at net interest income, we are going to see here, or excuse me, the provision for loan losses, much larger than expected. Not a great sign for some of these banks. JP Morgan leading the way there. And then finally, price action, John. You know, it's interesting. So we have these banks trading off today. All four of these banks on the year over the last year down about 20% or more. But take a look at this rally that we're seeing in JP Morgan and the banks overall. The banks overall out of that October low up about 20%, but JP Morgan ahead of today had been up closer to 35%. So we're seeing this dip. It's going to be interesting to see if it continues, but that trend to the upside right now, it looks relatively strong.
It's in a massive rally in that name since October or so. Abby, thank you for that. Equities more broadly about 2 minutes into the session, down about 0.7%. No real drama here. Hearing a lot from Jamie Dimon, warning some investors of further economic uncertainty and saying this: we still don't know the ultimate effect of the headwinds coming from geopolitical tensions, including the war in Ukraine, the vulnerable state of energy and food supplies, persistent inflation that's eroding purchasing power and pushing rates higher, and the unprecedented QT as well. Shanali on top of it all. Hey, Shanali.
John, not surprisingly here, as you're seeing those economic uncertainties really start to bake in, you are starting to see some very interesting cracks in borrowers when you think about consumers as well as corporate customers. Let me draw those out for you really quickly here, because charge-offs over at Citigroup, for example, rising. Remember, they are still coming off historical lows. These are not crisis era types of charge-offs we're seeing, but they are indeed starting to rise. Remember, this is as credit cards largely have risen very meaningfully, especially after the pandemic in more recent quarters for both Citigroup and JP Morgan. So when you see these reserve builds, that's really what you're talking about here. It helps them ink that net interest income that you like to see so much. For JP Morgan, though, however, they are going to likely come in short of expectations for the year. Part of that is because you're watching really deposits start to come back, especially in some of those higher yielding products like CDs. I will also say, interestingly, over at Citigroup, you are expecting a higher than expected revenue for the year. And what Jane Fraser is saying is still the phase one of her turnaround story. Because it is indeed phase one, John, you are also likely to see higher expenses than expected. Overall, on the conference call over for JP Morgan, you are hearing Jamie Dimon and you're thinking, is he sitting there penny pinching here? Because he's getting questions about expenses as well, and he is drawing out his dollar in, dollar out analysis for analysts here. Every branch we open and every banker they hire, they have to ask themselves what those dollars are coming in per those people.
Shanali Basak, thank you. Just on the financials, Ken Leon of CFRA saying financials can stay strong even as the economy cools.
I think if you have an environment of not too hot and not too cold, it's a great environment for financial sector, particularly banks, where the expectations are not as high as perhaps other areas that have benefited with a strong bull case scenario. Banks actually are in a pretty good position for performance for 2023 as we see it.
Pleased to say that David George of Baird joins us now. David, we often do this every quarter, so thanks for being with us, sir. I know that you're neutral on JP Morgan. You were neutral on Bank of America. Does anything about today's numbers change that?
Hey, John, good to see you again. Happy New Year. No, not really. I think certainly a lot of your comments this morning, it's totally ring true. But I think it's important, and I know the stocks are down today, to have some perspective. JP Morgan came in, we wrote in our note, the stock came in really hot. The quarter was fine. They made $11 billion. You think about everything that you and Sonali were just discussing, they earned $11 billion in the 3 months. So fundamentally, despite all of the uncertainty, all of the macro fears that are out there, it's still a fantastic business model. And from our perspective, it was just a valuation issue going into earnings more than anything else, rather than any meaningful fundamental issue.
David, something you said coming into earnings season, reasonably good, the setup versus the broader market. Why is that?
Yeah, so coming into 2023, to give you some context, we had a fairly constructive view on financials, and one of your earlier guests just kind of mentioned the bars a little lower. If we think about a year or so ago when maybe we were having this conversation, John, the stocks were 25% more expensive, and the earnings outlook is actually better today than it was a year ago, and that's a function of more aggressive Fed tightening than maybe we would have expected a year or so ago. So the revenue outlook is actually pretty good. Now it's really a function of what does the credit environment from here look like and how does that unfold. And we're of the view that it doesn't have to be binary. It doesn't have to be a soft landing in one camp and the great financial crisis in the other. We're of the view, and we're generally calling the 2023 the year of normalization in all things, and really kind of going back to 2019 as a core growth guide since we've had so much unusual activity and between Fed stimulus and taking that away. We're of the view that things are going to normalize really throughout the economy and the banking system as well.
David, when you say normalize, what does that word really mean? What does normal mean these days?
Well, we try and view cyclical stocks like banks, John, through a normalized lens. And what that means, more than anything, is what is normal from a credit perspective and credit costs in general. So JP Morgan, as an example, they only had 32 basis points of credit losses. What we would consider to be normal would probably be something in the order of 50 basis points. So it's while we're fully on board with the notion that credit is going to deteriorate, it doesn't mean that we're going to have a GFC-like scenario. Banks take risks, and they're expected to have losses. That is actually part of the business. So I think sometimes we get too caught up in the day-to-day delta, as it were, in terms of credit, as opposed to just thinking through the cycle, what's normal, and taking more of a kind of intermediate term view as it relates to that.
I'm about to get caught up with what's happening on the screen right now. Wells Fargo down by a little more than 4%. That's a stock you like. David, what happened this morning?
Yeah, it is. So a couple things. The expenses were higher than expected. They're taking some significant operating losses, which we think are to try and get in front of some of the regulatory issues that are certainly well publicized. And their net interest income outlook for 2023 was a little disappointing. And thematically, one thing that we've seen so far is the net interest income outlooks for the full year are a little light relative to where I think consensus kind of came out. And that's a function, John, of deposits and low-cost deposits moving out of the system into higher-cost alternatives. And that NII impact may be a little more muted than maybe some market participants expected.
Is that another way of saying they might be competing for our deposits sometime soon, David? Are they going to have to pay up for that?
Well, I think that's to answer your question, yes. I think that's going to be an industry-wide phenomenon as we go through 2023. I think there's going to be more of a food fight for deposits, and the days of paying 1 basis point for funding, we think, are generally over. And so that's going to be thematically something that we keep an eye on for sure.
I think a lot of us are happy with that. David, thank you, sir. David George there of Baird, thank you very much. You brought our equity market about 9 minutes in, down 0.9%. Jim Caron of Morgan Stanley joins us now. Jim, I just want to go straight to earnings with you. You look at the data, you look at what's happening with companies, and I know you see a bit of a problem ahead for profit margins. Why is that?
Well, look, I mean, I think it all really stems from what's likely to happen with the broader economy in terms of GDP growth. If you get slower GDP growth, you get, consumption, comes down as well. Consumption brings down GDP growth. And when we see the labor market, which we think is starting to soften up a little bit, that means consumers have less money. So what that then means is that corporations cannot pass on higher costs to the consumer. The consumer's just not going to be able to pay those costs. So what then that feeds into naturally is tighter profit margins. Once you start to get profit margins starting to narrow, you start to get this vicious cycle, because the way that corporations then go on to think about supporting those margins is by laying off more workers and controlling labor costs. And I think this is really the macro backdrop that we have to worry about in terms of thinking about this negative feedback loop that can start to work through the economy in 2023. And as I like to say, well, don't like to say it, but 2023 could be worse for Main Street than actually for Wall Street, because this is the environment where I think the consumer actually starts to feel the pinch of the long and variable lags of Fed policy.
So almost like the reverse of last year, Jim.
Yeah, in many ways we can think about it as the reverse of last year. It's really a lot of these long and variable lags that are really starting to come home here. So look, I mean, I think the Fed's in a very interesting position in terms of how we think about, how we think we're going to grow in 2023. In some cases, I think maybe some people might consider the Fed as chickening out on their inflation mandate. Look, inflation is coming down. We had a month-over-month CPI print yesterday come out negative, and we haven't seen that really since 2020. So, and that was just before the pandemic. So essentially what we're starting to see, our price pressure is starting to come down, and I think that's good, but it's coming down at the expense of slower growth and also potentially weaker employment, weaker labor, and also declining wages. So all of this then feeds through to, GDP growth, to earnings, to profit margins, and that's the cycle that's ahead of us. And John, I think the real question though is how much of this is in the price? How much of this do we think is actually, already there? And will we do worse than what people are already thinking? Because many people think the first half of the year is really where the adjustment's going to take place.
So Jim, here's my market question. What makes less sense? The S&P 500 near 4,000 or high yield spreads near 400?
I would say high yields. Well, okay. Well, this is good. Now let me frame this. I'm actually more positive on high yield, and so I would say the S&P makes less sense. I would argue that high yield spreads have more likelihood to do well, meaning tighten. High yield has more likelihood in higher quality risk-adjusted returns context to actually perform better. And the reason is because if the Fed starts to pause around a 5% policy rate, maybe they go in February, maybe they go one more time in March, and then they're done, then what that means is that the default risk cycle is going to be much, much more muted. So maybe you get that soft, bumpy landing. Look, I'm getting 8% yields, little over 8% yields in high yield. Spreads are a little over 400 basis points, or about 420 basis points. So I get that the spread may not come in a whole lot more, but I'm still collecting an 8% coupon. So maybe those yields actually start to come down, and essentially, which would also mean that Treasury yields come down a bit as well. But I'd rather collect that 8% coupon with more certainty of an easier default cycle than try to play I'm going to guess what equities may or may not do. So the way that we're structuring it in our balanced portfolios is we're trying to think about those two risks and try to find which is the better quality risk. And I'm leaning towards thinking that high yield is that higher quality risk.
Hey, Jim, stick with us. Jim Karen of Morgan Stanley there, looking at high yield over equities right now. Your equity market at the moment, about 13 minutes in, down 0.8% on the S&P and on the Nasdaq too. Coming up, Tesla cutting prices by up to 20%.
It's a great company. We just don't believe it's a great stock right now. It's unclear how long the price cuts are going to have to keep going.
And that conversation up next.
If you have a stock that's down 70%, I think that's the beginning of a train wreck. It's a great company. We just don't believe it's a great stock right now. It's unclear how long the price cuts are going to have to keep going. And why would you jump in now? Why wouldn't you just wait to let the dust clear? Because I don't think it's going to get away from you.
Tesla slashing prices by up to 20% across the US and Europe in a bid to boost demand. Analysts on Wall Street starting to sound the alarm. Evercore writing the following: there will be a significant impact to Tesla's near-term gross margins. The math depends on how long these new prices last. Ed Ludlow has more. Hey, Ed.
Yeah, good morning, Jonathan. Tesla down 6%, meaning it is now down 6% year to date. This focuses largely with more significant discounts on Model Y, 20% on the base Model Y here in the United States, as you said, or $21,000 off the more expensive higher-end performance model. There's more modest trims in price to the Model 3. What's so interesting is the emphasis Tesla is putting on that $7,500 incentive, which will last through to March of 2023. I think what's so interesting about the sell-side analyst reaction is not that this will result in a hit to gross margin, but actually that they see a pretty significant miss on that margin when we get fourth quarter earnings in a few weeks' time. This is coming off the back, of course, of price cuts in China, multiple price cuts. I think the debate now around whether there is a demand issue has probably gone out the window. But it depends how long these price cuts last, and indeed it can be a lever that spurs demand. And so I think we want to know the duration of the price cut and then what volumes will be going into 2023. There is some skepticism from some in the market that target of 50% average annual growth on production and deliveries will be achievable for the coming years.
Let's start with the bull case. Tesla at 116, down 5.8%. Dan Ives of Wedbush outperformed still 175. Said this: we believe altogether these price cuts could spur demand deliveries by 12 to 15% globally in 23, and shows Tesla and Musk are going to be on the offensive to spur demand in a softening backdrop. That's the constructive view. Let's put that to one side. The bigger issue for investors right now, Ed, is how to value the company. And you saw this from Wells Fargo. They asked the question of the moment for Tesla. There is a growing debate among institutional investors on how to value the company. Is it auto or is it tech? Which one is it?
Yeah, I mean, I go straight to 12-month forward earnings. I think we're around 25 to 30 when it comes to 12-month forward earnings, right? There's an interesting, way of looking at this, that if you applied a similar multiple to Tesla that carries for Ford and GM as an example, then the market cap that Tesla currently has would come down very significantly. You and I had this discussion many times over the last 3 years, right? That a lot of the valuation was put because of full self-driving, the future promise of robo-taxi. Now that the economy has changed coming out of the pandemic, there is a realization that Tesla is starting to be valued simply as a company that makes cars, and that demand for those vehicles is starting to pull back slightly. But there are many that are still bullish on the longer term about the software part of this business.
It's been a difficult year for both autos and for tech as well, for that matter as well. Ed, great work as always. Tesla over the last year, you can see it there on the screen, down 66% over the last 12 months. We are about 20 minutes into this. The equity market's down about 5 or 6/10 of 1%. I want to get a final thought now from Morgan Stanley's Jim Karen. Jim, I think you've been out front on this. You don't talk about defense, you talk about balance. Can you tell me the difference right now as we look ahead to a pretty uncertain 2023?
Yeah, so look, I mean, many people think about being defensive as ways to avoid risk or ways to participate in assets that just do not have a large movement in the markets, just tend to be lower volatility. Now, what I think is very, very important is that we balance those risks, meaning that we are in a situation where we have fat tail risks, meaning that we could get a hard landing, you could get a soft landing, and good things happen, and we have to balance those two things. So we can start by looking at cash, for example. We can start by looking at short duration instruments and funds in that area, and say that yields are pretty good. 3-month T-bills yield above 4%. That's a good place. Now, do you balance that by owning equity and high yield and other assets as well? Because if you're in an environment where you do get a risk-on move in the markets, the one thing I think is a risk is risk on. And I want to say that very, very clearly. Risk on is a risk. And the reason I say risk on is a risk is because people are underinvested in the markets. If you look at what is in money market funds these days, it's almost $5 trillion. So if you get a very positive move in the market, you can't afford as an asset manager, as a money manager, to move to miss that move. So you want to be in safer assets like short duration, high quality fixed income assets. but you also want to balance that against owning things where, if rates come down, if we stabilize, if we get a soft landing, asset classes like high yield, credit, and some high quality, maybe value orientated equities can also do well too. You want to be able to balance those two risks so that you reduce the risks through diversification. So the difference between defensive and balance is that balance reduces risks through diversification and keeps an eye on risk controls in that sense.
Hey, Jim, this was great. Jim Caron of Morgan Stanley. Jim, thanks for sticking with us, working through a lot there in both the equity market and in fixed income as well, and a little bit of portfolio construction at the end. About 23 minutes into the session, equities down 0.5% with a sector price action. Here's Abby.
Well, John, we are certainly coming off the lows. The S&P 500 now down about 0.5%. We have two sectors that are slightly higher, healthcare and staples, defensive sectors to the bottom, not surprisingly financials, but John, down just 1%. Some of those banks down less than 1% at this point, so it's going to be interesting to see how this day plays out. Tech right in the middle, down about 0.8% on the week, though, John. This is interesting. So we're looking at a second up week in a row for the S&P 500. Year to date, we have the discretionary space very strong, up 6.5%. You can see Amazon is a big contributor to that. Home Depot, too. But take a look at Tesla. Yesterday, I believe Tesla would have been about flat to up on the year, but now on the 20% price cut that you all were just talking about, down 5.4%. Super interesting. At its peak, Tesla, 20% of that sector, now about 10%.
Abby, thank you. Some big moves there for you. The broader market, no real drama, down 0.5%. Up next, your trading diary. 26 minutes in, equities down 0.5% on the S&P, on the Nasdaq down 0.5% also. Just a little softer, lighter negative as we close out the week. That's the price action. Let's get you the trading diary. Coming up, UMich Consumer Sentiment Survey at the top of the hour. More Fed speak, Kashkari, Harker on deck. Looking ahead to next week, US markets closed on Monday. Bank earnings picked back up with Morgan Stanley and Goldman. Plus we'll hear from Fed President John Williams from New York. That does it for me. For those of you stateside, enjoy the long weekend. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This is Bloomberg.
from the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, January 13th. Here are the top market stories we're following for you at this hour. Banks, planes, and cars. Earnings officially kick off. So far, not pretty. Banks drop as it gets harder to make money. Delta warns of higher labor costs. And prep for a hard landing. Goldman Sachs says hope for the best, profit more if you invest for the worst. We're going to speak to Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist. And happy birthday to Guy. Go ahead, buy Tesla. Tesla cuts prices on cars by as much as 20% just in time for Guy's birthday. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. And Guy, by my calculation, if I gave you $1,000 for every year you've been alive, you could now afford a Model Y. Congratulations with that price cut.
That's some complicated mathematics you've been up to there. I'd like to point out that my birthday is tomorrow, not today. Friday the 13th, probably not the day to have a birthday. I'm sure it's somebody's birthday out there today. Happy birthday to whoever it is. The markets, I think, Alex, are having a fairly mixed day today. I'm sure it's the banks. I'm sure it's the banks' guidance that nobody likes today. I don't think the Tesla price cut is helping, though.
Yeah, also I have to say the S&P failed at the 200-day moving average yesterday. You know, you never like that, and it's a long weekend here in the U.S., so you're not going to want to take on a lot of risk. But all that said, we are well off the lows, and we had some breaking data just in the last few.
Let's talk about that. My takeaway from the University of Michigan numbers, and I'll be interested to get Mike McKee's take, is the consumers like lower inflation. Mike, give me the numbers.
Well, as our former Vice President of the United States, Dan Quayle, once said, happy campers you are, happy campers you will be. It looks like people do like lower inflation, and the fact that it appears that growth was reasonably strong in the fourth quarter, because we get the Michigan overall sentiment number jumping significantly to 64.6 from 59.7. That's well above the 60.7 that was forecast. And we see that current conditions and expectations rise. Current conditions up almost 10 points to 68.6 from 59.4, and expectations are at 62 from 59.9. When you look at household finances, 31%, an increase from December, think that they are going to be better. 25% think they're going to be the same in the year, and more people, 27%, think they will have higher incomes. So they're feeling better about their personal financial situations. Now, the inflation aspect of it, this is the interesting one, because so much drives their perceptions, but the news has been good, and one-year inflation expectations dropped to 4% from 4.4%, a significant drop in inflation expectations over 1 year. The 5 to 10 year number is down to ticks up a little bit to 3% from 2.9%, but that's a little bit less worrisome. It's a little harder to see exactly what is driving that. Should say that the 1 year inflation expectation, the lowest since May of 2021. The thing that really drives people's perceptions of inflation, gasoline prices. We talked about this yesterday, I think, on your radio program, that gasoline prices are starting to go up again. So we'll see if those inflation expectations hold.
Yeah, great roundup of the data. Thanks a lot, Michael McKee, joining us there. Let's get more on those numbers with Joanne Shu, Director of the University of Michigan Surveys of Consumers. She joins us now. Joanne, let's start on that inflation point. What's your read on if inflation expectations can continue to go down, or if that reverses if gasoline prices start to rise again?
So consumers are, of course, going to be very aware of gas prices, but they are responding to the prices of everything that they purchase. We've seen inflation expectations 1 year ahead decline quite a bit, not just this month, but over the last couple of months. Just 2 months ago, it was 4.9%. Now it's 4%. Consumers are expecting the slowdown in inflation to continue over the next year.
The sentiment numbers are amazing, Joanne. The current conditions number has gone from 59.4 to 68.6. That feels like a very big jump. Am I reading that right?
It is a big jump, and it's happening for two primary reasons. One, as we mentioned before, the slowdown in inflation has really helped consumers' pocketbook. The other thing is that buying conditions for durables have gone up quite a bit, and that's because consumers are perceiving that supply chain issues have really eased up or have disappeared for durables. So both of those things are propping up current conditions.
What about the labor market? I mean, how is that helping or supporting that current sentiment?
So labor markets kind of has two pieces to it. So first of all, consumers, their assessment of their personal finances are also being buoyed by expectations of strong incomes in the year ahead. We're seeing a median increase of about 2.6%. That's higher than we've seen recently. And so consumers expect their incomes to be strong, and that will support their consumption going forward. That being said, they are expecting labor markets to weaken in the year ahead. The largest proportion of consumers expecting unemployment to increase than we've seen in recent months, and so they are expecting that to weaken.
Nevertheless, if I look at these data, I'm assuming that the consumers feeling fairly good about the world right now. I hear what you're saying. There are caveats. How should the Fed be reading this data, do you think, Joanne?
I think the Fed should look at this data and feel like their fight against inflation has worked to some extent to control short-run inflation expectations. But what we know is that the Fed cares much more about long-run inflation expectations, and that's at 3.0%. It's been bouncing around between 2.9 and 3.1 for 17 of the last 18 months. So in spite of this recent reduction in inflation, it hasn't really moved the needle all that much on long-run inflation expectations. But those weren't really all that much higher than pre-pandemic inflation expectations to begin with.
So, Joanne, what is going to move the needle on that longer-term inflation expectations? What's going to get that down more substantially?
I think it has to be a really sustained reduction in inflation. So, Guy, you were saying before, consumers seem to be very hopeful. The thing is that they're very hopeful relative to where they were 6 months ago when we saw the all-time low back in June. So overall, consumer sentiment remains fairly low from a historical perspective, just less low than it was before. And I do think consumers are still waiting to see sustained improvements and kind of uncertainty over global factors like China and the war in Ukraine to not worsen in the year ahead.
Joanne, all great points. Have a great weekend, a great long weekend. As ever, thank you for bringing us the data and the analysis that goes with it. Joanne Shu, University of Michigan Surveys of Consumer Director. Coming up, we're going to bring you the latest on big bank earnings and the market reaction. Peter Oppenheimer is going to be joining us, Goldman Sachs Chief Global Equity Strategist. That's next. This is Bloomberg.
season is here.
Wall Street expecting a bit of an ugly season.
People may be overly pessimistic.
We know growth is slowing.
Companies are going to have a lot of questions to answer.
Bloomberg breaks the numbers first.
Tons of banks coming out.
Some of the worst returns when it came to profit.
Markets really like that number.
With exclusive expert analysis.
What's your confidence in your outlook?
You got to be selective.
We still see a lot of opportunity.
There is a light at the end of the tunnel.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
So, 4 major banks in the United States out with earnings today: JP Morgan, Citigroup, Bank of America, and of course Wells Fargo. They offer an insight, I think, into how consumers and companies are faring during these challenging economic times. So here with the top takeaway from Wall Street from a macro perspective, our Wall Street reporter, Sonali Basak.
Listen, when you look, Guy, at the numbers so far, you do have net interest income increasing, but there is some pressure ahead when you look at these loan books ahead for the big banks. If you take a look at it, you also see some headwinds, for example, because you'll finally start to see deposits once again. Remember, rates were next to nothing at a lot of these banks, and you are starting to see savings rates potentially going up finally this year at some of them, although the final levels are TBD, to be determined. And when you look at it also, you also see provisions for loan losses, very importantly here, starting to tick higher, as well as charge-offs. On the charge-off side, you are not seeing things that are very drastic, nothing crisis level, but at the same time, they are higher than expected. On one hand, it's good that they're starting to put some of the reserves behind them, and it shows you that these banks are willing to take on risks, particularly in the credit card books. I will also say, interestingly, you are seeing some cracks when it comes to corporate borrowers as well, as you see some of the banks starting to show you not only a drop-off in debt underwriting, but also some pressure when you look at businesses like the premiums on credit default swaps rising. That shows you a little fear baked into the market. So not all in paradise. You definitely see that reflected in the bank stock reaction this morning. Clearly, these banks are well capitalized and handle it. With JP Morgan's 20% return on tangible common equity is higher than the goals that they have announced in the past. But at the same time, there's clearly some pressure ahead.
Just in terms of broad strokes, what we're hearing from the CEOs on the calls. Recession, mild recession, what's the overwhelming takeaway?
The general consensus so far, if you think about what they've said over at JP Morgan, it very much matches what they said over at Citigroup. What Mark Mason has telegraphed, this is a mild recession towards the end of the year. Now, they all telegraph it could get worse. The Citigroup line has been, for the last couple months, remains today. You may see a rolling recession around the world, which frankly, in many ways, is better than all at once. So you did see it reflected in the numbers. You did see some pressure in other parts of the world more than you did in the United States, Asia in particular in the fourth quarter, which could start to ease up this year. So mixed bag, but mild recession. Fourth quarter is the general take.
Great reporting. Busy day. Sonali will be back with us in just a few. Bloomberg Sonali Basak joining us there. We're going to have more on those bank earnings. We're also going to have an interview with CFO Wells Fargo. That's coming up at 4 p.m. New York time. All right, broader macro here. David Kostin of Goldman Sachs out with a note telling investors it is best to prepare for a hard landing, just in case. He writes, the painful investment lesson of 2022 was fine to hope for the best, more profitable to invest for the worst. Let's get Peter Oppenheimer's take, Goldman Sachs Chief Global Equity Strategist. Peter, do you agree with that call? I don't even know if I can ask you that question, but if you agree with that call, you want to prep for the worst as how you're going to make that kind of return. How do you do that right now?
Yes, hello. Well, of course, I certainly agree with that, but I would say it's important to distinguish here between the financial markets and the economy. We do have a relatively positive view on economies globally. In fact, we're not looking at a recession in the U.S. This year, and looking for the economy to grow in the U.S. at around 1.4%. We're not even looking at recessions now across Europe broadly, as they've been helped recently by lower gas prices and, of course, by the pickup in China, which we expect to be accelerating quite a lot through the year. That being said, because of that strength, interest rate risk remains higher than the market is pricing. And that was where it really feeds into a more cautious view for equity markets. The valuations are still quite high. They're pricing in good news. Cyclicals are rallying sharply. And we still look for very, very modest profit growth over the next couple of years, even in the light of getting through without recessions, mainly because of margin pressure. So positioning for a more defensive outlook in the markets we think makes sense.
Peter, it's Guy. Let's just tease that apart a little bit, if we might. You don't think that we're going to see recessions. By extension, does that mean we don't see rate cuts from the Fed?
Yeah, that's our view. Our rates colleagues are looking for further rate rises both in the US, Europe, and some other places. We're expecting the terminal rate to get towards 5.25, but importantly, we don't expect interest rates in the US to be falling this year. We don't think they'll start to come down until perhaps early next year. Of course, the markets are now pricing rate cuts in the second half of this year, and I think that's too optimistic. So the good news is that global growth is better than many people feared recently, and there have been some important supports that have come through: lower energy costs, the opening up of China, continued strength in labour markets, particularly in the US. But on the other side, that means that core inflation is going to remain higher than central banks want it to be, and that feeds through into the discount rate and equity prices.
Peter, we're having some connection issues, so we're going to have to let you go on that, but please come back imminently when we can fix the connection. We'd love to hear more of that call. Peter Oppenheimer joining us of Goldman Sachs. And Guy, I think this also winds up getting to the point of then what's actually baked in for earnings, right? We all are sort of looking at a rough first half and a better second half, but then you look at what happened with the banks. If you miss on certain metrics, your stock is going to get hammered. So what is actually priced in, and then where is that tail risk?
Well, I think the expectation is that we are, as you say, going to see a better second half. But if you listen to the banks today, I don't think the banks are being marked down today on their numbers today. And I know there were some misses in terms of the numbers that were delivered. It feels like it's the outlook statement, doesn't it, that is causing the problems here today. And you tie that with Tesla, you tie that with what we're hearing from others as well. It is going to be rougher for longer, maybe, would be my perception. And that's not kind of where the market is right now. There is this kind of expectation that the back half of the year is better, that rates come down, that stocks stabilize, and you can see a decent investing environment. I wonder whether that's now being increasingly questioned. But the Fed does sound like the message from the Fed is quite clear. We're going to 25. But ultimately, we're still going to end up in the same place and probably stay there. So again, I just wonder whether the Fed's been overread a little bit over the last few days as well.
Well, I also feel like the conversation evolving, and it's not how they get there, it's how long they stay there. And just because they stop hiking doesn't mean they cut. And then that also making a difference. And Bank of America, for example, thinks that we're looking at another 10% downside for U.S. equities to 3,600 until we actually end the year higher. What's kind of the catalyst to get us there? Is it going to be earnings season? I mean, some of the numbers and the outlooks weren't great, but then you're looking at the S&P, we're only down 0.3%. So I don't know.
It's been an amazing start to the year, though, hasn't it?
Yeah.
You look at what's happened. You look at what's happened here in Europe. You look at what's happened with luxury. That's the China reopening trade. You look at what's been happening with the bank stocks. They've had a really solid start to the year as well. You take a look at what's happening with the airline stocks. Some of the most beaten up areas have been rallying hard. The question I'm trying to figure out is whether or not you get the kind of the dash to trash early, and that is something that sticks, or whether it's just something that's short covering. Is this the start of how a normal cycle would evolve, i.e. people get back into the stuff that is least loved?
Or is this a normal cycle in any sense of the word? So, I don't know. Lots more to discuss.
Absolutely.
It'll be fun.
It is. We've got plenty more still to talk about. Let's talk about Apple next as well. Tim Cook's pay is going to be cut. It's kind of voluntarily. Investors sound like they've been pushing for it as well. He's okay, apparently, with just $49 million in 2023. I don't think his fixed pay is changing. Anyway, Ed Ludlow is going to join us next to talk about this. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Tesla's slashing prices in the US and major European markets after several quarters of disappointing deliveries. The electric car maker lowered the cost of its cheapest Model Y by 20%. Buyers can save as much as $21,000 on Tesla's most expensive vehicles. Delta Airlines is forecasting first quarter profits that fell short of Wall Street estimates. That's a setback for the carrier's efforts to capitalize on a rebound in air travel demand. Delta is being hit by soaring labor costs. And 3 months ago, Goldman Sachs created a new division to house what's left of its foray on Main Street. Now it's giving shareholders a clearer look at the financials. That collection of businesses, including Goldman's Apple Card, is now in a segment called Platform Solutions. It racked up more than $1.2 billion in losses in the first 9 months of 2022. And that is your latest Business Flash, Guy.
Ritika, thank you very much indeed. So it is 22 minutes past 7 on the West Coast. It's time that we got to the startup. We cover tech stories from the Bay Area and beyond. Silicon Valley starting its morning. As we've been discussing though all week, Ed Ludlow's in New York. He is heading back to San Francisco, I understand, after a rather peripatetic trip round America over the last few weeks. Ed, nice to see you. Let's talk Tim Cook.
Sure.
I want to talk about the reduction that we're seeing in his pay.
Yes.
Has this come about because of something that he wants? Is this something that has come about as a result of shareholder concerns, or is it just a combination of the two?
Yeah, look, Apple is cutting Tim Cook's pay for all of the above reasons, right? It's a drop of 40% to just a more modest $49 million total compensation value for 2023. We found out about this through a regulatory filing Thursday night, in which they basically said that this came about as a result with reasonable proposals, balanced shareholder feedback, they called it, but shareholder engagement, and also a proposal apparently from Tim Cook himself. I think there was some language in there which at first I didn't quite understand, but they say going forward they're going to match Tim Cook's pay to the 80th and 90th percentiles relative to our primary peer group for future years. My question around that is, like, who is the Apple executive peer group? You know, in terms of all these people earning tens of millions of dollars each year. Really importantly, though, the proportion of the compensation that is performance-based stock rewards is increasing from around 50% to 75%, and will be reflected that way going forward. So do a good job, Tim Cook, and you'll still be well paid.
Yeah, I was going to say also, like, when you're looking at your peers, are you also taking into account stock comp?
Right, and one thing I would say as well, like, think about the environment we're in with Apple right now, okay? They are not doing layoffs per se, but in November, Bloomberg reported that they would freeze hiring outside of the R&D space. You know, we're waiting on earnings, but the last 3 months of 2022, calendar 22, you know, everyone on the street started to revise their full year units forecasts because of supply chain disruption, but also a lack of demand at the lower end. It was not straightforward for Apple. December was the worst month for the stock going back to May of 2019. They don't say that in the regulatory filing, but one does wonder if they're saying, okay, we need to get real with what's happening in the global economy and what's happening with our share performance, or at least our company's performance.
Ed, what's the macro read from TSMC overnight?
Yeah, I've been fascinated by this story partly because of the reaction of the TSMC ADRs, US listed shares. You know, they were up some almost 6%, right? And so they are forecasting revenue that's below guidance, below forecast from the street, and they're cutting capex modestly. And the narrative is around sort of weakness in the first half of this year and slight improvement in the second half. But that for me was interesting. Why does that justify a big jump in the stock? I think there was a lot of emphasis put on what they were talking about, the auto industry, and now TSMC and others being able to supply these very basic processors and chips, which has been a real problem for the auto industry. That at least is one market where we'll see growth for some of these chip makers in this calendar year. But a really mixed bag and a strong performance or a strong reaction. I guess we saw this last earnings period.
I wonder if the bad news then is baked in.
Right,
Is that what we learned
and you
too?
also reward those that take action in the face of adversity. We saw that, you know, people cheered layoffs, people cheered pullbacks in capex. So interesting story.
Ed will be back, have no doubt, because there's a lot of Tesla to go through as well. As I mentioned, we got those price cuts, guy can now afford one if we give him some money for how old he is. It's important.
You're going to keep pushing this, aren't you?
Oh, totally. Are you kidding? And I can't wait for my birthday now. It's going to be great.
Well, people are emailing saying, can you really get a Tesla for $30,000?
It's a deal. It's a total deal. Guy's really young. All right, coming up, we're going to talk about Delta. Shares are down hard. We'll discuss. This is Bloomberg. We're about an hour into U.S. trading sessions, getting pretty interesting. We're now seeing the Dow in positive territory. The S&P, the Nasdaq basically pairing most of those losses of earlier. Abigail's tracking the moves. Abby?
Yeah, it is pretty incredible. Take a look at this U-turn, Alex. So into the financial reports, this big earnings season kickoff, the S&P 500 E-mini futures basically flat and then down sharply, I think down almost about 1% or so. And now down just 0.2% or thereabouts, as Alex was talking about. The Dow is higher. Let's see whether or not these other indexes can follow. Now let's take a look at the banks, because this is a piece of the action. And you can see here, JP Morgan, it had been down more than 3% at the lows, now down 0.4%. It won't be surprising if that stock flips higher. Bank of America, Wells Fargo, still down. Messy quarters from most of these banks for various reasons. And then take a look at Citigroup, because it's interesting. Their FICC trading beat in a big way. So it seems that investors are paying attention to that. And we now have Citigroup in the green. Will the other banks follow, or at least JP Morgan? As for another sector that's under pressure, the autos, if we take a look at Tesla, and I know that you all were just talking about this with Ed, Tesla right now off of its lows, down 3%. This, of course, after they are cutting those prices by 20% to, I guess, prices that everybody is stimulating interest in wanting to maybe buy a Tesla. General Motors and Ford down sharply, down 5%. Now, one possible boost for stocks that could help to explain 2 up weeks in a row for the S&P 500 on the year starting off, is that you have yields starting to come in. Now, they're not plunging
plunging in, but they are creeping down. And at this point, you have that 2-year yield at 4.15 below the 100-day moving average, suggesting that maybe it's going to try for that 200-day moving average and drop significantly on the idea that maybe the Fed is going to, I think the pace is pretty determined that it's going to be slower, but that maybe the terminal rate, that battle between the Fed and investors, maybe that investors are going to win. We'll see. I would bet on the Fed on that, but this chart does suggest yields are going to be coming in. As for one sector that is just absolutely stunning on the year, Guy, Delta down a little bit today. Their quarter, the results for the quarter was good in terms of demand, but first quarter profits are going to be hit a little bit by rising labor costs. Take a look at these airlines on the year. This is just 9 days of trading, and you could say that this could be a rally for the year, but a big bounce back so far. I guess the question is, will it continue? It seems the demand is there, but can they manage costs?
Can't believe you didn't talk about the shares taking off, or at least going down that road. Abigail, thank you very much indeed. Abigail Doolittle and what's happening in these markets. Well, let's carry on the conversation about what's happening with the airlines. The stock performance year to date, absolutely stunning. But are the numbers there to back them up? George Ferguson, airline and aerospace analyst of Bloomberg Intelligence, joining us now. Let's talk a little bit about Delta, George, because I think it may be emblematic as to what we're going to see from the whole of the airline sector, particularly in the United States. At the moment, the numbers look good. Top line is good. There's clearly demand for travel. There's clearly ongoing pent-up demand for travel. The problem comes in the middle of the P&L. The problem comes with margins, because it looks like costs are going to increase and stay sticky. If you're an investor in the airline sector, therefore, which number do you look at? Do you look at the top line, or do you look at what's happening with margins?
I think I always look at margins, right? As a analyst investor, I always want to see improving margins, and I always want to see profitability, right? Whatever falls out of the bottom of a company in profits is what makes my investment in that company more valuable. And so, yeah, the challenge here is totally going to be how do they recover the increased costs, for the pilots, right? Pilots have an 18% increase on the table and 5% at the end of the year. Look, I mean, definitely the numbers we saw, yields look pretty good. So, that's synonymous with ticket prices. So it does look like there's good demand. But look, I think the right level of demand in the marketplace is a level of demand that supports profitability. And so, we've had higher costs in fuel. We have higher costs coming with labor, and fuel looks like it's going to relax a little bit. I'd argue that probably the market needs to see a little less capacity next year to even firm up prices more if they're going to if labor's going to get this kind of gain from the companies. Yep.
George, I'm wondering why the stock is down. I know the reason, but I'm wondering why everyone was surprised by this. Like, didn't we know that higher labor costs were coming? Like, what was the whoops here?
Yeah, I mean, we do, and so we know what's on the table. Actually, look, Delta may have guided a little bit lower than they think what they can do. I was pretty surprised at the guide, right? So I thought the guide looked pretty low.
Yeah, what is it, 15 to 40 cents? I think the market was looking for 59 cents in terms of the guidance on EPS going forward. So, yeah, maybe a little light there. I'm assuming, George, that also this amazing rally that we've seen in some of these share prices over the last few weeks since the beginning of the year is also part and parcel of the declines we're seeing today. How much more can you get out of these companies? What do you make of that rally?
Yeah, I think coming into the year, I think investors were hoping that, again, demand would hold up, right? And maybe if the Fed is done easing here and we don't actually get pushed into recession, the U.S. economy looks better than we all thought. Demand holds up and profitability is better in these companies. But, again, that remains to be seen, right? It remains to be seen how much the consumer is going to pull back in the face of these higher interest rates in a slowing economy.
So, George, with that, and we're seeing Delta take a hit today, what is the best airline stock to own in this uncertain environment? Like, who is going to have the pricing power or going to maintain margins, and who is going to have that top line?
Well, so I would tell you that what's concerning is coming into the year, we would have thought that the fundamentals for, the financials for the big full-service carriers, United, Delta, and American, would be best suited for this market. We think that business is still coming back. That ought to be a tailwind. International markets are still reopening. There were some great yields in here for some of the international markets, especially Asia-Pac. As Asia-Pac opens, demand ought to increase. and then we had to get some good fares out of that. So we would have thought the full-service carriers were well-positioned, and we thought there'd be a lot more competition for the low-cost, for the low-cost carriers, the leisure flyers, especially domestic. So it's a bit surprising, I think.
George, Ed Bastian talking about, over at Delta, talking about the fact that he thinks that the FAA needs to spend more money on ATC after the issues we've seen this week. Does he have a point?
He does. I mean, you can't have a ground stop for everything in the country. You can't do that many times, right? That definitely doesn't help business. But what company doesn't need to spend more money on IT, I would say, though? That's the challenge in life is, right, the priorities. So.
Yeah, exactly. Who doesn't want to have a better system, but still really antiquated? Hey, George, really appreciate it. Thank you for the update. George Ferguson of Bloomberg Intelligence joining us on the airlines. All right, coming up, big banks, they're seeing the headwinds in 2023. Bank of America's analyst call is currently underway. The latest headline here is that they see mid-single-digit loan growth coming out next year. We're going to get the investor takeaway now. Cole Smead, Smead Capital Management President, is joining us next. This is Bloomberg.
This is Bloomberg. Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. The two Trump companies found guilty of tax fraud last month have been sentenced to pay more than $1.6 million. The small sum is due to limits under New York state law. The real punishment could be that the former president's business could get frozen out of deals, bank loans, and government contracts. Japan's Prime Minister Fumio Kishida will seek public support for his new security strategy today from President Biden. The two leaders will meet at the White House. Several weeks ago, Japan announced a radical upgrade of its security policy. It includes a 60% spending increase and plans to acquire missiles capable of striking China. And in Germany, the economy probably stagnated in the fourth quarter. That is easing fears that the war in Ukraine and inflation have triggered a recession. For the year, GDP rose 1.9%, just ahead of the estimate in a Bloomberg survey. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg Guy.
Ritika, thank you very much indeed. So US bank earnings calls have been going on over the last couple of hours. Bank of America now taking questions from analysts. What are they saying? Let's find out. Bloomberg's Wall Street reporter Sonali Basak has been, as ever, listening in. What are they talking about, Sonali?
A few things to keep an eye on here, Guy, and it's how do they make money moving forward, which is for Bank of America, JP Morgan, there's a lot of focus on the consumer still being pretty strong through this environment. Bank of America is saying that you're even still seeing consumer spending consistent with a 2% growth environment and low inflation. So with that said, it's credit cards. It's the credit card businesses, which is why you're seeing them kind of shake off this idea that charge-offs are rising a bit and provisions and reserves are rising. Reserves are building, those provisions for loan losses are rising. I will also say, if you think about just how sluggish the last year was for investment banking, you have to think at this point the only way to go is up. You have in the hundreds of millions some businesses. For equity underwriting at Citigroup, for example, less than $150 million. I mean, these are kind of peanuts for these banks if you think about how sluggish the business has been. For that number in particular, down 68%. These numbers are down more than 50% for almost every single business line. So that is somewhere where if you look at JP Morgan, who says not only is the pipeline coming back, it's challenging still to convert those, but the pipeline is coming back. They're also open for business with leverage finance. I think this idea that the banks want to take on some risk in this environment despite what their view is on the macro is a very important dynamic when we think about the uncertainties of the year ahead.
Based on the individual businesses of all these guys so far, who is best to capitalize on that? An okay consumer with some clouds, an investment banking bottom, and a trading arm that's still super solid and taking on more risk. Who has the runway?
I think you have to look both at JP Morgan and Citigroup for two different reasons. One of them being that both of those fixed income businesses are simply massive. Bank of America showed the biggest percentage jump increase, but remember they had a somewhat smaller base that they were going off of when you looked at their fixed income business. You had more than $3 billion, 3.78 at JP Morgan, that was a miss, but at Citigroup you had a huge beat, a record really performance there, stunning really. And what it also shows you when you look at the value at risk rising for JP Morgan, again, they are willing to take on risk. Markets are still volatile. It's going to be interesting to see, as we've been talking about all year, how the rates, currencies, commodities, businesses start to fuel these businesses moving forward. Jane Fraser in particular in her statement pointed out that what she's trying to build is, again, a bank that is good in many different environments. Huge card business, huge trading business, and I've got to say the other thing that's kind of on their side here is the fact that the valuation has plunged just so far for Citigroup. They're trading at half their book value just about, and they're still saying that their phase 2 of their turnaround plan doesn't even start until as early as next year. So they're early in this turnaround story, but those businesses are the ones that both JP Morgan and Citigroup in particular can lean into.
Great analysis. We will get more. You're going to go back to listen to the calls. We'll get more from you in the next hour as well. Bloomberg's Sonali Basak joining us. All right, remember we have the Wells Fargo CFO interview that's coming up today at 4 p.m. New York time. Definitely don't miss that. All right, for the trader and investor take, Cole Smead, president of Smead Capital Management, is with us. He holds Bank of America and JP Morgan in his portfolio. And looking at Bank of America down 1.5, JP Morgan now trying to climb in positive territory. Cole, do you like these numbers? Do you buy the dip here?
Well, I mean, overall, Alex, what we find interesting is, the theory of Fed raising rates, asset markets falling apart, and then something breaking. has been it's been a fallacy. It's been a myth to a certain extent. I think if you look at the comments coming from the CFO of Bank of America, he said credit card delinquencies are drifting higher, which means they're just kind of moseying their way. That's not a jump. That's not a tectonic change in the credit card business. So I think as we look at the economy, because these banks are just kind of a derivative of what we're seeing in the economy, what's interesting is, can these banks get in a lot of credit trouble tied to consumers when the best wage gain in America right now is actually the lowest income, right? If you look at the Federal Reserve Bank of Atlanta data, they would tell you that the lowest income is actually seeing real wage gains more than anyone in America. That's usually who gets in trouble in terms of credit. And it's really tough to get in credit trouble with those kind of folks versus, wealthy people are getting hurt in the stock market and the bond market. At the same time, they have the highest amount of checkable deposits they've ever had in their existence. And we still have not spent down the savings that we built up over the last 2 years.
Cole, that's all great, and from a top-line point of view, that all kind of works, and I guess from a risk point of view, that all works. Just things are getting more expensive for the banks. They're having to pay more out on deposits. Jamie Dimon was warning about that. The cost of hiring people is going up. Where does the risk lie sort of operationally in terms of how the margin story is going to develop? What does that look like?
Yeah, it's a good question. So when they say things are getting more expensive, I mean, if you're Bank of America, for example, we actually just profiled this in our last webcast. I mean, the cost they're paying, 1 quarter ago was like 11 basis points on the high end. So let's just say, guy, that doubles to 22, 25 basis points. That's a huge pickup. At the same time, relative to what you could lend the money out to the government on 2-year treasuries, it's a dream. So how I look at this is like, you look across their credit book, they're going to have credit risks increase just over time, just naturally. That's a pretty natural thing, I think, at this point. At the same time, the spreads, they're being compensated for that in the spreads. Mm-hmm. Think back to like late 18 when we had a stock market fall off and the Fed was really worried about how that would affect the economy. There was no spread to compensate you like you have now. So I think it's a vastly different world where these folks have an interest to lend many places on a 2-year basis to cover their risk that could increase.
I gotta say, I'm making 4.3% on my Marcus account. I don't know if a 22 BIP increase is really gonna do it for me, but point taken. Where, though, do you think that ROTC targets are too high for these guys?
So how we look at this, Alex, is you go back to, I think the tectonic shift of rates is what people aren't thinking about. In other words, their return on capital, they were already overcapitalized coming into this, okay? And this is not a capital issue. That's what we dealt with coming out of 08-09. We had to figure out how much capital they had to build up. And then the question is, will they ever produce a return on capital again, return on tangible equity? Today, it's not a question of capital. They can swallow anything inside of quarters. At the same time, it's really, people want to know what are they going to make. But the multiples have backed off too. So using Bank of America, you're not sitting that far off a book compared to being at 1.5 to 1.6 times book in the last year. And so, or last 2 years. So I look at it as based on what you're going to get, let's say mid to low, or low to mid teens ROE on a business like Bank of America or JP Morgan, and you're not paying much more than book. How attractive is that relative to owning a stock market that's just doing terrible? I think it's really an opportunity cost game. Banks look like they're going to make good money over the next decade, and we're just not that optimistic about what the S&P 500 can do in comparison to that.
Okay, let's break that down a little bit. Which banks do you like, and which assets in the banking sector do you like? And I bring in kind of the credit side of things here as well. Am I buying credit over equity? Yeah. Am I buying JP Morgan over Citi?
Well, yeah, just broadly speaking, kind of our framework for the banks has been the investment banks are going to suck for a while. I know they think there's going to be a pickup. Pickup will be where people need to raise capital because they need the capital. That's a good thing for those investment banks. But we're not going back to where we were a year ago, a year and a half ago. That game's over. Wall Street sold the products they could sell while the mania was going, and that's pretty typical. So we're really most interested in the commercial and consumer bank side. And that's why I mentioned those stats on the consumer earlier. We just think that's the game. And right now, Guy, another place that you have nothing going on, mortgage banking is just quiet and dead right now. And people are very negative about housing because of the where we're at where we just went to on mortgages, but that will also pick up. So there are things that they could benefit. But again, the wealth management business, how would you want to be in the wealth management business while stock and bonds lose money right now? The amount of money raising in asset management at large was paltry last year. So again, the things that were the strength, the wealth management, investment banking, those games are going to slow down a lot, and they won't go back to where they were in multiples and earning power.
So, Cole, it seems like you're definitely more positive in the consumer. Where can you get the best pickup for that?
Well, I would say, we look at Bank of America as really the biggest consumer touch, for what we see versus, to your point, we don't own Citi, but they have a big credit card business. JP Morgan, we think of it as less consumer oriented compared to Bank of America, for example, in our portfolio. So, another one out there, Alex, we own Credit Acceptance Corporation, which is going through quite a spat with the CFPB right now. That's subprime auto lending, okay? That's really at the consumer that's winning right now. So we look at that as like the bottom quartile of income. When you need to get a car, who's going to provide you that car, and who's going to put together a lending program that the dealer's not going to screw you with a bad car. That's what credit acceptance does. So we like this economy. We like that kind of consumer because they're the person that you go to get your food, and they're hiring 5 of them and they can't find any of them.
On that note, Cole, let's wrap it up. There is this expectation that the Fed is going to be cutting rates at the back end of this year. You're describing an economy that doesn't need cuts. What's wrong here?
What's wrong is when wealthy people have their net worth impacted, they want to cry and tell everybody that the Fed needs to help them. And it's the same person that benefited over the last decade. So if you think about it, the wealthy are now losing, lower incomes are now winning, and the wealthy are mad. That's what it looks like to us. So everyone's praying for a buy the dip, lower rates, and the reality is, I beg your pardon, but this stock market never promised you a rose garden.
On that note, have a great weekend, Cole. Lovely to speak with you as ever. Thank you very much indeed. Cole Smead of Speed Capital Management. This is Bloomberg.